Welcome to the Ashburton Institutional Conference. I'm Patrice, Chief Investment Officer. The marvels of technology has meant that I've been teleported in the midst of this conference, here to discuss the first panel topic about the global and SA economy and investment opportunities with two of the brightest minds in the group, Nico, our SA strategist, and our Chief Economist, Ettienne. I'll start with the first topic or question. Nico, after a decade without recession, the global health crisis was a real heart attack to the global economy. Activity has frozen, global trade slumped, the virus itself continues to spread with 20 million cases globally. And the world's wealthiest nation, the US, is struggling to contain infections with 5 million cases. The real investment debate here is how is the global economy coping, and are we likely to see a V-shaped, U-shaped, W-shaped, even Nike shoe-shaped recovery? What's your view and Ashburton's view on the state of the global recovery and its pace going forward?
Yeah, thanks, Patrice. Welcome, Ettienne, as well, and to everybody that's dialed in. What we've witnessed over the last year has truly been unprecedented. We've probably seen the biggest contraction in global growth since World War II. And obviously now the question is, how do we go going forward? So, if you look at the US, for example, they contracted by almost 33% in the second quarter. And now, since the third quarter, as the economy's reopened, things are looking quite a bit better. In fact, if you look at most economic indicators, it looks like a V-shaped recovery at this point in time. But we at Ashburton kind of referred to that Nike swoosh sign. So in the beginning it looks like a V, but then it peters out and it takes at least about 2 years to get back to the recovery pre-crisis levels. Obviously within the jurisdictions they differ. America started very well in Q3, but then with the virus infection numbers increasing in certain states, they had to lock down, and you can more recently see these numbers tapering down as well. Europe at the moment is looking slightly better, although they also had a disastrous second quarter. Things look to be improving there quite nicely. I think what will be watched going forward are the infection numbers as they're in their summer holidays. And then one of the areas that we actually quite like is Asia ex-Japan. China went into the crisis first. They seem to be doing better at this point in time. That's also boosting that area.
That's great, Nico. And of course, the loss of life is tragic, but what of the economic impact? How would you calibrate the permanent damage likely to be felt for years to come?
Yeah, so a lot of economists refer to that 90% economy, 10% kind of permanently damaged. If you think about the damage that has been done, one can firstly maybe look at the employment numbers compared to previous recessions since World War II. You can clearly see on this chart what impact it had on employment. You've never seen such a big fall down compared to previous recessions, and on average it takes at least 2 years to regain that. And interestingly, on the right hand side you can actually see Fidelity analysts were asked to their companies, would they use this crisis to alter their workforce? And you can see that the sectors that's really been severely negatively impacted, like the energy, industrials, consumer discretionary, financials, you can see in their answers clearly there's going to be permanent employment damage to those companies. So that's one of the reasons why we are not too optimistic. Secondly, with all the fiscal stimulus that has been bestowed upon the economies, we're going to end up with a lot more debt. That debt needs to be repaid back. Thirdly, if you actually also look at the crisis, we've become used to globalization. That was good for inflation, that was good for productivity. But I think this crisis has also kind of found us in supply chain problems. Certain countries are reliant on other countries, and that's going to have a big impact going forward as well. And I would just say lastly, I think because of all the stimulus, it's probably survived a few of the so-called companies, zombie companies that probably should have fallen, and that going forward is still going to be a big concern, where maybe the the insolvency rates have actually just been delayed by all the stimulus. So that would be something to look forward to as well.
Yes, Nico, I like the word, your phrase zombie companies. It's quite a morbid picture, and yet markets globally have clawed back most of their March losses. And it's really the S&P beating the drum here, even though the US has the most cases of COVID globally. How do you explain this? What's your insight on how markets have been driven currently?
Yes, I mean, we read a lot of commentators saying that the markets are pricing in this V-shaped recovery. We would probably differ with that analysis, mainly for two reasons. I think if you deep into why the S&P has been up year to date, there's a clear distinction between what sectors did well. So for argument's sake, if you look at the top 5 shares of the S&P, for the first time in history, they're all the same sector, being information technology. And they are now representing 20% of the S&P index. So I would say if you're pricing in a V-shaped recovery, you would probably prefer the lower cyclical value stocks, and they were the ones, if you look at the Russell 3000, that's really underperformed, where your top 5 shares have proven to be growth, they've proven to be defensive in this crisis. Last week they came out with results. These guys are printing money. So we wouldn't say it's pricing in a V-shaped recovery. In fact, once we get more optimistic about the economy, you'd probably find a rotation from those growth defensive stocks into your more cyclicals. And then secondly, also what has certainly helped the markets over the last couple of months has been the unprecedented fiscal and monetary stimulus. So for example, if you look at what the Fed balance sheet has done in just 4 months, it's grown its balance sheet the same as what it's done in 5.5 years over the global financial crisis. And a lot of that liquidity has found itself into financial markets, but again, it's found itself into the winners being technology and healthcare.
That's very interesting. I especially like your chart on the S&P because that's quite fascinating. What are the risks to markets at this point in time, in your view? What could really derail this global recovery and this huge surge in market?
Yeah, look, there's many risks, and just to briefly touch on to all of them quickly. I mean, the crisis was started by the virus, so the first thing we probably need to look at is the infection rates, where's second waves, third waves, and obviously all the talk about the vaccine as well. I mean, that's going to be critical going forward. So those are things we need to monitor. The US elections is around the corner in the beginning of November, and the electioneering campaign is now heating up. Biden hasn't really done that much till now. He's just released or announced his vice president, which wasn't a surprise, but the polls are actually starting to favor him, and it'll be interesting to see how Trump reacts to this in the build-up to the elections, which brings us to trade wars as well. He's certainly upped the ante with regards to trade wars. And that's probably going to intensify going forward as well. Certainly something we need to monitor. On the inflation front, because we are probably slightly less optimistic about global growth as consensus, we still think the short term for inflation is probably a deflationary problem, but we recognize the fact that there's been a lot of reflationary projects that's actually taking place fiscally. Money printing machines are on, so that's something we need to follow closely. And then just lastly on the currencies, obviously the volatility has been quite hectic over the last few months. It probably will continue going forward. As a house, we've been relatively bearish on the dollar, and it seems like that theme is starting to play out.
Thank you, Nico. I think let's switch tack to the South African economy. And Ettienne, we were talking earlier. I thought you were following the same fashion style as the Minister of Finance with the financial shoes. This was a big discussion at budget time. But the South Africa cannot be decoupled from the global carnage. We had an economy which was limping before this global health crisis. What's your prognosis for the S economy this year? And maybe, if possible, could you really distinguish between the exogenous shock of COVID from the global economic viewpoint and domestic issues that we have to overcome in Kenya?
Sure, thanks, Patrice. Just conceptually, we think about COVID-19 as something that has inflicted 2 macro shocks at the same time. So we've got the virus, and it certainly had a significant impact on world trade volumes, enough for the global economy to go into a deep recession. Now that obviously is a big deal for South Africa. We're a small economy, but we're quite open. So for example, if you take imports and exports combined, that's about 60% of GDP. So the point is, with a deep global recession, that in itself will be enough for South Africa's GDP to contract by 2 to 3 percentage points. Then we have to add the severe consequences from the hard lockdown that we've experienced domestically. And there are various consequences, direct, indirect one, induced ones. You put all of these things together, we come to the conclusion that South Africa's GDP in the context of COVID-19 will contract by about 8% or so. Now what is striking about that data is that it would put South Africa's GDP this year to be equal in size to what it was in 2011. It just gives you an idea of how severe this shock has been.
Yeah, this is quite gloomy, Ettienne. I guess 2020 will be a year we might as well write off. Is there any glimmer of hope you can provide us with? I mean, what about the prospects into 2021?
So the 8% contraction that I'm talking about is obviously with reference to the calendar year. Now that's a tale of two halves, because we all know that the data is going to look terrible in the first half of this year, particularly in the second quarter, when the lockdown restrictions became effective. But the second half of this year is going to look much better. Now, after all, if you open up a sector and you just need a little bit of economic activity off a very low base, you're going to see good growth rates. And I think that's what we're certainly going to see in the second half of the year. If you focus more on 2021, and on the basis or on the assumption that the global recovery that is currently in play, if that gains more momentum, if the stimulus, monetary and fiscal policy stimulus implemented locally, if that is effective, and hopefully the government continue to relax the restrictions and that the economy is fully open in the next few weeks or so, under those kind of conditions, Patrice, I can see the economy delivering 2 to 3% positive growth in 2021. That being said, it's quite important that it's going to take a while for South Africa, our economy, GDP, to be back to the levels it was at in 2019. So we just need to be realistic about that as well.
Yeah, I think it's quite a sobering picture, Ettienne. But let's bring it back to the investment side. On a micro level, I've seen the work that you've done looking at the SA consumer and how the consumer has reacted to this unprecedented lockdown. Could you share perhaps some of your findings in terms of the businesses that have been adversely impacted, the likely beneficiaries from the lockdown, and what are currently a lot of the South African businesses doing to survive this crisis?
So consumers, as kind of cash-strapped if many are, they obviously become quite conservative. It is quite clear that priority items are being favored over non-essentials. So there's a lot more spending on groceries and pharmaceutical products than there are on luxury items, and that is completely understandable. That being said, there are a few signs that retailers of durable and semi-durable goods are starting to benefit from a little bit of pent-up demand being unleashed. So we need to monitor that quite carefully. Other than those interesting patterns, there are new ones as well. We're all working from home now, so we're certainly spending more on telecommunication and spending more on data. We're certainly spending more time online as well. You also asked about companies, and you're so right. Companies are in survival mode, and they're doing a lot of things just to do exactly that. On operational level, we're certainly seeing companies cutting costs, and they are doing whatever they can to boost efficiencies. They are looking for economies of scale. Now, how do you get economies of scale? You merge divisions, you centralize operations, you restructure your companies. We're seeing all of that taking place in corporate South Africa. And it is also sad to say that companies are investing less. and they're making significant adjustments to their payrolls. Now, it's all understandable that companies are taking these actions, but we also need to understand that the actions that they are taking are actually depressing economic activity in the interim. Strategically, corporate South Africa is also using this as an opportunity to relook at their business models. They are forming new alliances or JVs. Companies with financial muscle are using the opportunity perhaps to gain market share or to bind market share, I should say. Companies are selling non-core assets. There are various examples just in the last week or 2 weeks of companies actually even disinvesting. And this is how corporates are adjusting to the reality. Over and above all of those things, they're obviously doing whatever they can to beef up their balance sheets as well.
Yeah, that's a very good overview. We're a little bit pressed for time. What are the one question many of our clients ask is the prospect for the rand, given this very recent depreciation? And maybe one or two comments on that, Ettienne?
This might surprise the audience, Patrice, is despite the relatively gloomy picture for South Africa, we are actually constructive on the currency. But it's not because we are bullish on the rand. It is more to do with the fact that we are bearish on the US dollar. We all need to just keep in mind that the dollar is a counter-cyclical currency. If the recovery outside of the US economy continues to take hold, as capital move from the US more into riskier destinations, the dollar is going to stay under a bit of pressure. I would also be of the opinion that the Fed has made it perfectly clear that they're not going to hike interest rates anytime soon, and all you need is for inflation expectations to drift slightly higher, and real rates will stay low or perhaps even fall further, and I think that's going to depress the dollar somewhat. So I think we can easily see the rand going back to levels of 1650 by the end of the year.
That's so it's not all fall down. And maybe to round off, Ettienne, any good news you could leave us with, maybe on the inflation front?
Well, good news, besides the fact that we think that we can see 2 to 3% economic growth in 2021. The other good news, as you rightly point out, is with inflation. There's obviously a close relationship between the economy being in a deep recession this year and inflation being low, but there are other reasons as well. We're talking about the second biggest maize crop on record in South Africa. We're talking about price discounts to try and get consumers back into the shops. And also, very importantly, we're talking about a relatively weak residential property market that's going to keep rental inflation well under control. All of these things, to me, mean that inflation is going to stay quite low and perhaps surprise us in the next month or so by trading even lower. So the good news for me there, Patrice, is that that can create an opportunity for the central bank perhaps to cut rates even more, which are already at record low. And that must be something that's good.
Okay. At least you've left us with some glimmer of hope here. And just to round off, Nico, if I could ask you for your asset allocation position, given the sobering picture you painted earlier.
Yeah, sure. I think what we've heard today is probably defensive, still prefer quality, growth, and a defensive positioning in our balanced fund. So within SA equities, we underweight quite a bit. And even within our SA allocation, we kind of focus on the companies that are deriving their revenues mostly from offshore. Bonds, we are at this point in time overweight, sitting close to the fire on that one, because obviously we are concerned about the fiscal metrics and how it's deteriorated over the last few whiles, but we think that a lot of that bad news is priced into the market. We prefer the front to belly portion of the curve. And with real rates where they are, you're still getting up CPI plus 6% on a 10-year bond and less. So that to us is quite attractive. On the property side, we underweight there. That's probably the one sector that's really grey and hazy, and they've really been severely affected by this crisis. And we need to see some more clarity before we convincingly up that position. And then more recently, in the last rand strength, we did actually go fully offshore according to our Reg 28 limits. And within offshore, we are probably relatively square on or neutral on equities, slightly underweight developed markets, slightly overweight the area that I mentioned, Asia ex-Japan. Fixed income, same there. We're probably slightly underweight on developed market bonds and especially the negative yielding bonds. We've recently added to Chinese local bonds. We're overweight on the investment grade corporate bonds as well. And then we end up with cash, where we still feel there's enough in the kitty to try and seek some opportunities.
Thank you very much. Thank you very much, Nico, for your insights here, and to Ettienne for your great overview of the South African environment. I'm sure the audience would have found both your talks very, very insightful. I'd like to hand over to our next team. It's Vicky Tag, our head of passives, Chris Sriram, head of LDI, and Hannes, who's our real propeller head here, who runs our systematic trading strategies, to discuss the topic of strategic asset allocation.